Thank you for joining us for this episode of Wealth Insights. Joining me today is Tommy Xie, Head of Greater China Research. We will be sharing the prospects of China as the Chinese leaders are set to convene their 20th National Congress in October. China has set the date of the meeting on 16th of October earlier than expected. So Tommy, is the earlier than expected date positive for the economy?
Yeah, I think it's marginally positive for the economy for two reasons. First, it means all the dust has settled. The political transition is likely to be smooth. In addition, President Xi's visit to Kazakhstan in September also reinforced the view that China is politically ready for the next 5 years. Second, I think it will also help reduce implementation risk, as most junior level officials and the party members are able to focus on their work while the senior lineups are being finalized.
Will China change its zero-COVID strategy?
I think a certain pivot away from the zero-COVID strategy in China is quite unlikely. However, I do expect China will relax its restrictions gradually in the coming month. If you look at the big data from Shanghai during the outbreak in April and May, less than 0.1% population developed severe symptoms in Shanghai. With more outbreaks in the past few months, I think the data will be supportive of the gradual opening. In addition, the new leadership under the President Xi will try to step up their efforts to meet the new expectation of the Chinese people, of which return to normalcy is an emerging expectation among the ordinary Chinese people.
So Tommy, will China's top leadership shift their focus from political stability to its economic recovery? Are we expecting a bigger stimulus package?
Yes, I think China is going to roll out more measures to support the economy. So therefore, I think the risk in the property market is unlikely to spill over to other sectors. However, given the continuation of the policy framework, China will stick to the bottom line, which is to prevent the systemic risk. Therefore, I think for the housing market, the street rate lines to contain the leverage ratio by the developers are likely to stay. Overall, I don't think China is going to overstimulate the economy.
What should investors watch out for under the new leadership?
The current leadership de-emphasized the growth target in the last term. So will the new leadership reinstate the importance of the growth target or continue to de-emphasize the growth target? So that will set the tone for China's growth trajectory for the next 5 years.
From OCBC's wealth advisory perspective, we have anticipated existing growth measures to be supportive, as well as these policies should support a gradual recovery in China. This includes policy rate cuts, real estate sector stabilization measures, and the latest infrastructure support. However, economic headwinds and challenges in corporate earnings are likely to persist in the coming months. Hence, we prefer our China onshore A-shares as many of the negativities have been priced in and long-term risk reward may be compelling despite of the possibilities of near-term volatility. To our viewers, we have come to the end of this edition of Wealth Insights. We hope you have found this sharing useful. And about the implications of China's economy and stock market, you may speak to your relationship manager. I'm Aaron, signing off at our latest branch at Wisma Atria. See you in our next edition of Wealth Insights.